Let's ask Ashwini Agarwal that. Ashwini, hi, good morning. Great to have you on the show. And Ashwini, when you live in such volatile times, with all the news flow around West Asia, which refuses to subside, nor does crude, because of its impact, I guess it gets a little difficult to form a view on the market. What are you feeling about the sudden turnaround in the news flow yesterday?
Morning, Aisha. Watching the news these days is a lot of fun because it's literally like snakes and ladders. Every morning there's a new roll of dice and there is a new development, and it's just not predictable, right? So the only thing that as investors, what can we do? We can look at only two things: certainty of earnings and where are valuations relative to history or for a particular stock relative to its peer set. That's the only thing that we can on a broader market basis. I think I personally feel that there's not a lot of downside. I mean, of course, I will caution this by saying that, look, if things were to go really south in the Middle East, against all sort of reasonable estimates, then of course there's a lot of downside, but we don't know that and we can't predict that. And the other risk, of course, on a global front is if the AI trade starts to unwind, if there will be any spillover effects on investor sentiment. So, if you leave those two things aside, I don't see a lot of downside from domestic factors. Broadly, my thesis has always been that the currency is a huge predicator of foreign flows. And I think that with the FCNR inflows that are likely to happen between now and September end, and the sort of taming of inflation to some degree that we're starting to see via the energy prices, you should see a stabilization of the rupee, and that I'm hoping will help foreign flows. So, reasonably constructive that there's not too much downside, but also cognizant that there are macro factors at work which are very hard to predict.
Right. But Ashwini, those March level valuations are obviously not going to come back unless, of course, you have the AI trade reverse and then God knows what's going to happen in the world. But looking at where the markets are right now, where is it that you have valuation comfort?
So, Aisha, if you look at private sector banks as one case, where you look at trailing 12-month valuation and you draw the charts going back to as long as you can, they're trading pretty much at the bottom of their entire trading history. And I think the overall business environment for banks is quite constructive. Credit growth has picked up. Deposit growth is lagging a little bit. Interest rates are kind of stable. Asset quality and capitalization levels are very good. So if you take that into account, at worst, you will capture earnings growth. So let's say, earnings growth is in line with loans growth. So something like 15%, give or take, you should be able to capture. And if a slight bump up in re-rating happens, say even a 10 or 20%, that's the cream on top. So it's a reasonable return outlook, from a 12 to 24-month perspective. So, that's one area I find quite attractive. The other is pharmaceuticals and healthcare, both hospitals and pharmaceuticals. Here, I don't think there's a top-down story, but there's a bottom-up story where you can look at individual ideas. Healthcare is a growth story for the next 30, 40, 50 years in the country because, unfortunately, for us, the government is not able to provide the health services that people seek, and private sector is stepping in to provide to fill the gap. With help of insurance, the uptake in the uptake of private sector services is going up. So this is a growth story that has very long legs. And in pharmaceuticals, I'm very positive about the shift in focus among companies from being purely generic drugs providers to being innovation-led providers, whether it is in form factor, whether it is in delivery systems, whether it is in complete novel drug platforms. So I think that's one area one should I feel fairly confident about.
Ashwini, do you think the markets will discount this conflict like it has discounted the Russia-Ukraine as well, even as we find alternate supply chain routes as well as we go along?
Uh, this is not as easy to ignore in the Indian context compared to Ukraine-Russia conflict. The Ukraine-Russia conflict had very limited impact because maybe to fertilizer prices to some degree, but otherwise it didn't really bother India that much. In the case of the Middle East, if oil prices persist at higher levels, because the conflict escalates and Hormuz is closed again, that hurts because we are a large energy importer. Sure, you can find alternate supplies, but alternate supplies have limitations. Last bit of the conflict over the last 3 months was helped by the fact that the world drew down on their reserves. Now the reserves build back has to happen. So I don't think the next phase of the war, if it were to escalate and if the Strait of Hormuz were to be closed, is going to be as manageable as the last 3 months were. Having said this, I don't think US wants a war. I mean, even if you look at what the president said between yesterday afternoon and late in the evening yesterday, his time, I mean, I think there's a change in tone. Also, I don't think Iran wants a war. So I think they're looking for solutions, except that they can't agree to what a reasonable position for both of them to arrive at is. So I think you'll continue to see volatility, but answering your question, if the war were to become a full-scale war, then you will have its impact on energy prices, and that will hurt India, especially in an environment where food inflation is likely to remain tough, given uncertain outlook for monsoons this season.
Ashwini, how do you look at IT? You'll have TCS's numbers which will come out today. You believe that the numbers will be much stronger than what many are penciling in. There's a margin cut expected towards 24%. You believe that any kind of a small beat could be a positive trigger?
I mean, valuations are obviously, quite attractive, again, on a historic basis. But I think here, what I will look to see is the commentary about growth. See, there is deflation on the top line is a given. We all get it, right? What is the impact on margins? I mean, are we able to compensate for loss of volume by adding more value and therefore protect margins? Or is that not happening is something that I'd love to see. I've not been invested in IT for the last 3.5 years. And while valuations are starting to look attractive, I think the toss-up between loss of volume and increase in margins is still unclear to me. But valuations are attractive, and I grant you that if there's a slight beat, you'll probably see the sector rally.
Ashwini, I just want to go back to the point that you were making about healthcare, because that's where stocks are expensive. So I'm just scratching my head as to what is it that you would recommend buying right now, or maybe even adding positions.
Aisha, I looked at Apollo hospitals, 20 years ago and found it expensive. And, it was a very good education for me. See, when stocks have a long runway for growth, okay, then near-term valuations can be expensive and can remain expensive for a long period of time because investors are saying, hey, this is certain growth. By buying something which is expensive, I'm giving up 2 years of returns, but I'm locking in 10 years of returns thereafter. So I think, near-term valuations are punchy. I agree with you. But I think on a long-term basis, there are very few businesses that give you this kind of visibility. So, that's the kind of lesson I learned, and that's what I'm sharing. So I think it's best not to sort of be turned away by valuations when you're certain about long-term growth.
20 years, Ashwini? Wow. You could retire officially.
Yes. Been around a long time, so I guess that's part of the game.
Yeah, absolutely. But that must feel great to be sitting on Apollo hospitals and for so long and at that kind of an
Aisha, just
attractive
to
valuation.
clarify, I said I learned a lesson. I missed it for valuations. Okay, and that's the lesson I'm trying to share. Yeah.
Got it. Okay, so that's that on Apollo hospitals. But, this entire EV adoption and, the entire ethanol play story as well, Ashwini. Any opportunities here too as India slowly but gradually would migrate to renewables as a source of fuel, and of course automobiles as well would progress that way?
So I think everybody is trying to broaden their automobile portfolio. I mean, I'm talking about the car makers here by offering alternative fuel cars, by offering EV of cars, and so on. And I think all of them will grow. So as a consumer, if I have the luxury of owning more than a vehicle, I would definitely want one of them to be an EV. So I think EV penetration will go up to maybe 30%, 40% in the next 4 to 5 years. And that's a huge opportunity because you take the car sales today, compound them by, let's say, 10% a year over the next 5 years and take 30% of that as EV. That's a huge market for you. We've seen quite good offerings from all the players here. And I think this is a great growth opportunity. I think overall automobiles, again, as the nation grows and gets a little bit richer, your volumes will grow. I think margins is something that we have to watch out for because battery technology is evolving and we still don't have complete ecosystem there. So how the margins evolve is something I'm keen to watch. But if you just look at the commentary from Tata Motors, both on the PV side and on the CV side, I mean that shows you the kind of growth that's possible. So I think these are interesting times for some of these companies, and I think there's uh, one of the things that's very heartening is that over the last 10 years, you've seen companies now become mature in terms of the kind of products they're able to offer, the quality, the finish, the performance on the road. They're as good as you get. I mean, there is nothing to say that Indian cars are not as good as what we get from elsewhere in the world.
How do you learn from something like the miss with regard to healthcare that you had maybe a couple of decades ago, uh, where valuations have run up, but there could be a decade of growth ahead of us? How do you kind of rationalize that? How would you, thinking back, rationalize that? How would you correct the mistake today? What would the themes be for the next 10 years, where probably stocks are expensive, but there could be decadal themes? What would those sectors, spaces, pockets be?
So hospitals is clearly one of them, right? Because here I don't have the have an alternative. I mean, AI can replace the way these surgeries are conducted or the advice is dispensed, but the need for us to visit a hospital when something is wrong with our health is not going to go away. And the payer system is falling into place. So I think that's another advantage. And this is not something that can be competed away, by people who come in and from overseas or offerings, elsewhere. So this is a very, very good place to be. Many have argued that defense offers a similar opportunity, and I find that accept because my sense is that the nature of defense is changing. I mean, if you just see the war in Ukraine or you see what's going on in the Middle East, I think the contours of how battles are conducted are rapidly changing. Also, I think, I don't like businesses where government is your sole buyer, where, payment terms, etc., are always under question, or, what you get and when you get it and so on and so forth. So order visibility is not very clear. So I stay away from businesses where visibility is low. But if I'm convinced about the visibility, then it's worth paying that premium because let's say a business is growing at 10, 12% a year. Okay. At the minimum, that's the rate of growth you'll get. If you compromise 1 or 2 years of no returns, your return may fall down to 8% or 9% or slightly better than that. I think on average, my expectation from, let's say, the Indian large cap marketplace would be somewhere mirroring India's nominal GDP growth, which would be about 11, 12% a year. So is that the kind of return that you can lock in some of the hospital stocks? I believe so. You could even do a little bit better by 1 or 2%. So that's not a bad return to have in your back pocket, and you're not there's very little uncertainty with what the demand outlook is. So that gives me comfort. So that's what I've learned, that be greedy, but be long-term greedy. I mean, that's something that, is a very famous line, which is quoted in a book on Goldman Sachs, that be greedy, but be long-term greedy.
Ashwini, we need to plan a very different show, a masterclass with you. And, that shouldn't be time bound. Lots of learnings on how to pick stocks, what to look at. We'll plan it sometime.
Thank you, Aisha.